One financial misstep cost him over $4 million. But for millionaire Jamie Rogozinski, that actually wasn't his biggest regret. For the first time ever, Jamie is sharing his true story and how this experience ultimately led him to Stansberry Research's crypto expert, Eric Wade. Learn why digital cryptocurrency and blockchain technology could change the trajectory of your financial future in 2022 and beyond with Eric's free copy of his new report. In it, he shows you why Bitcoin has proven itself as an excellent store of value in the long term. You'll want to see why this is more important than ever as inflation reaches 41-year highs. Plus, the name of an important asset, not Bitcoin, that everyone should own immediately before it revolutionizes every business industry in the world. In short, today as many as 89% of Americans are getting left behind. If you don't want to be one of them, you owe it to yourself to discover the best way to begin. Simply go to betterthanbitcoin2022.com to get your free copy. Again, that's betterthanbitcoin2022.com for a free copy of this new report. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is Thursday, May 19th, 2022. Another beautiful day here in Baltimore. Live from the main studio, as you can see, we have the markets not looking as good as the weather outside. The S&P on the verge of a bear market. As we know, the NASDAQ is already in a bear market. And yesterday was the ugliest day that we've seen in market going back to 2020. We're going to talk about that. And it wasn't just the tech stocks, folks. It was some of the bellwethers, the ones that were supposed to be the safest companies out there, getting taken out to the woodshed. We're going to discuss that. We're going to discuss retail numbers. We saw Target, we saw Walmart in the last week really get crushed. But at the same time, consumers still look strong. Retail sales keep going up. So what is the disconnect that's going on in the market right now? We'll dive into that and much more in today's show coming up on Making Money. Again, this is Matt McCall. Thanks for joining me here on Making Money. It is the 19th of May, 2022. It's a Thursday morning. We're about 75 minutes or so into trading, 10:45 or so. And as I mentioned, we had a very rough day yesterday. We had the major indices with their worst day since 2020. We have the S&P not too far away from a bear market, down about 18.5% or so. And this morning, down about 0.8%. With the NASDAQ actually holding up a little bit better. And actually some of the innovation stocks holding up even better than that. Some are actually up. So we're seeing a bit of a wild market. But we're going to dive in that today. We're going to talk about some retail stocks. We're going to talk about some numbers out there that really show just kind of the situation that we're in. It is a very odd situation. I will tell you that. It's people are saying it's like 2008, 2009. Other people are saying it's like 2000 tech crash. I mean, you're starting to see some really crazy, let's call them predictions coming out from major firms, from big names in the market. And I got to tell you, when everybody starts turning this negative, it's tough to kind of get on board with them because it's almost as if where have you been during the pullback of a nearly bear market, the bear market in the NASDAQ. And as I talk about a lot of times, almost half of the stocks in the NASDAQ composite, which is over 1,000 stocks, nearly half are down over 50%. So we've already, again, taken out to that infamous woodshed. So let's jump into the markets here and take a look at the S&P 500 and give you an idea what it looks like on the chart. Here is the SPYs, the SPYs, the S&P 500. As you can see, we're down about 0.2% right now. And if we look here, this was the low of last week and we rallied back. And then we had the big sell-off yesterday, the big red candle there. And again, today down about 0.2%. So the low you want to watch here is about 385 on the SPYs, which tracks, of course, the S&P 500. And we're about 389 right now, so not too far from that level. If we break below that, we're probably going to move into a bear market because that's right on the cusp of the bear market, which, as we all know, is when the market pulls back 20% from a high. So the level you want to watch is 385 right there. I don't know where we go from here, honestly, in the very near term. Long term, I still am extremely bullish. I think there's so many stocks out there that are so undervalued, quote unquote, cheap now. But what we have to keep in mind, folks, is stocks can get cheaper. That pendulum swings so far, so hard to areas of irrationality, and that's getting close to where we are right now. Let's take a look at the QQQ, which is the NASDAQ 100. As I mentioned, only up a little bit better, down about 1/3% right now. Again, you want to watch this low around 285 or about 290 right now in the Qs. That 285 level is the intraday low that we had of last week. That is very important support here, just in the near term, not long term, but in the near term, it's very important support. And then I wanted to go over to the ARK Innovation ETF, ARKK. Strangely enough, this is is up ARKK, up 3.1% right now, near the high of the day. So you would think that you'd be seeing the innovation of high growth getting crushed, but I'm starting to feel like, you see the base that we're building, we're not even close to retesting the lows from last week. I'm starting to feel like maybe the innovation and growth stocks, they've seen their woodshed moment. They've already been taken out. They're done. And you're starting to see it flip over to some of the more conservative stocks. And I'm going to talk about some individual stocks here in a moment, but let's take a look. This is the XLP. This is the Consumer Staples ETF. Look at the hit it's taken in the last 2 days alone. Fallen from, or last 3 days, from 77 down to 70. So about a 10% pullback in 3 days in what is supposed to be the conservative, the safe place to hide during a potential recession, during a potential bear market in the S&P 500. This should be the safe place. And let me zoom out here for a moment, folks. That was an all-time high. That was an all-time high just a month ago. And down from there. So this is, again, I don't know if there's enough people talking about this, but yesterday, how bad some of these stocks, again, these safe havens, got hit yesterday. And if we break down that XLP and we take a look at, okay, well, what makes up the XLP? What's driving this pullback? If I take a look at the top holdings, Procter & Gamble. I mean, think about Procter & Gamble. What does Procter & Gamble do? Basically everything you need for your house. Coca-Cola, PepsiCo, Costco, Philip Morris, Mondelez, Altria Group, Walmart, Colgate-Palmolive, Estee Lauder, Archer Daniels Midland, Kimberly-Clark, General Mills, Cisco. All foods and things you need. These are staples. When people get to the point of selling these, it's a time where they're basically wiping their hands, say, I'm done. I hate the stock market. I'm selling everything. I'm getting out. I don't want to deal with it. I want to look at a couple individual companies and highlight some of these for you, because the moves that they made yesterday were pretty much unprecedented, to be honest with you. So let's take a look at some charts here. This is Clorox. Let's think of it as bleach, right? It's got a beta of 0.37. What that means is, if you have a beta of 1, that means you basically move hand in hand with the S&P 500. So in theory, if the S&P 500 is up 1%, the stock's up 1%. If the S&P 500 is down 1%, it's down 1%. 0.37 means if the S&P is up 1%, it's up 0.37%. If it falls 1%, it in theory only falls 0.37%. So lower beta means less volatility. So all the stocks I'm going to talk about have betas below 0.7, so lower betas, but Clorox getting crushed. What about Smuckers? Everybody knows what Smuckers is, right? JM Smuckers. Look at this. Again, let me zoom out and show you this chart. This was close to an all-time high back from 2016. Smother from 146 down to 124 in a matter of about a week and a half. What do you think of when you think of that? Jelly, right? PB&Js, peanut butter and jellies. So are people going to stop buying jelly suddenly? No. It's man, a local company here, McCormick, right? McCormick makes spices. Are we going to stop having spices? No. What about Church & Dwight? Makes all kinds of staples, including baking soda. Crushed. Oh, one of my favorite condiments of all time, ketchup. The Kraft Heinz Company, crushed. This is something that you see over and over. One of the favorites here, Hershey's. I mean, look at this great chart on Hershey's, HSY, suddenly getting crushed. Look at the long-term chart of Hershey's. One of the greatest long-term charts you'll ever see in a stock market. I mean, Hershey was down below $10 in the early 90s, up to 230. Selling chocolates. Chocolate, folks. Confections. Crushed in the last couple of days. So are people going to stop buying chocolate? Are people going to stop buying cereal? You know, one of the stocks that I always think about, or two of them I should say I think about, when I think about safety, right? I think of Campbell's Soups. That was always one. Again, crushed. The other one is Hormel, HRL. And do you know what Hormel is known for? One of my favorite, maybe I won't eat a few times in the last 10 years, but growing up on it, we grew up with not a lot of money. And Friday was pizza, especially during Lent. But Two foods we ate way too much of were Vienna sausages. I don't know if you ever saw those in a can, those little like hot dog looking things. I kind of liked them as a kid. I tried them recently and they were not nearly as good as I remembered. And the other one was Spam. And Hormel, HRL, makes Spam. I know it's a delicacy in certain areas around the world, especially in Hawaii. But it's a canned jelly-ish meat, pork, I believe. But I used to fry it up as a kid and love it. Again, I tried it recently. It's not the same, folks. But those are things that you're not going to stop buying Spam or bleach or soup or cereals or jelly. But this shows that investors have basically thrown up their hands and said, I'm done. I don't want to be in the market. So I want to pull up a couple other charts here that I think kind of show exactly where we are right now. And one I want to take a look at here is this is the cash levels for the fund managers. It's a percentage of their assets under management. These are big fund managers. What the cash levels are at. The cash levels right now, meaning these big funds, these institutions, see the spike right here? This is May 2022, where we are now, higher than we had during the pullback of COVID, higher than the little near bear mark we had in 2016, same thing in 2012. 2008, the great financial crisis, more cash than that, 2003, going all the way back to September 11th, that fateful day, 2021. So you're going all the way back, and what that's telling us is it's not just retail investors that are selling, the big guys are selling too. And when you have cash levels this high, you look at all these areas, they were very close to, if not at major market bottoms. And what that means is you're at major market buying opportunities. So again, folks, I think we have to kind of put a lot of this stuff into perspective at when there's cash on the sidelines like this, these institutions can't sit on this cash forever. It has to go to work. But it almost as if they've flushed out and sold everything too, or they're getting redemptions from their investors saying, I'm done. But again, this starts telling us and pointing to a time where, historically speaking, it's near that sweet spot. This is not the time to throw in the towel because there is a ton of cash sitting on the sidelines. But here's another one. This shows global growth optimism. It's at a new record low. Again, below where we were pandemic. Below 06, below 08, the great financial crisis, below December of 2000. This is a percentage, the net percentage of people expecting a stronger economy. Look how low it is. It's like negative 70 or something. The lowest that we've seen going back to 1994, the year I graduated high school. The lowest growth optimism that we've had since I was a teenager. That has to tell us something. That people we're so negative already. So I think when you start thinking about, okay, selling now, we are at that bottom. I haven't felt that capitulation yet, I'll be honest with you, but we're so damn negative. It's kind of this slow burn that we're going through. So again, it's tough to kind of throw in the towel now when majority of people have thrown in the towel. Again, I'm not saying we can't go lower in the near term, but again, it feels so ugly right now. And here's one looking at the midterm years, and the largest intra-year pullback typically happens during midterm years, which we're in right now. The average pullback going back to 1950 during this presidential cycle, one of these 4 years, is negative 17.1. We've pulled back around 19 or so in the S&P, so we're not too far away from the average pullback during a midterm election year. But what you see in the gray numbers here, look at this huge number. This is the S&P average return a year after the lows during the midterm year. Again, I don't know if this is a low, but we're going to hit a low at some point during this year, and history shows us that we rally big off the lows. So you have to say to yourself, do I think the low's in now and I buy now? Do you say I'm going to wait for the low to be in? Because I don't know if we know when the low is going to be in. But start looking for those sweet spots. Those spots where you're looking at stocks that you truly feel that you would love to own here. You'd love to own years going out. And you don't know if it's a bottom here necessarily. And again, I'm not saying you run out and you buy everything here. You hold on to your quality stocks. If you have stocks you hate and you don't want, get rid of them. If you can't sleep at night, get rid of them. That's your own decision. But my point is that we need to think big picture here. You start thinking about the world's ending, the stock market's ending. It's no longer a way to make money. We have to just do something else. I don't agree. I disagree. The people that have said that over the last 150 years did not do well in the market. The people who zigged when everybody else is zagging has done well. The sheep get crushed. The wolves don't. You have to be the wolf. You have to be the vulture. Whatever animal you want to refer to, that's what you need to be. All right, so we kind of stand right there, and that's just how I'm viewing this right now. And just to kind of make you not feel as bad, I guess, through the first 95 days of this year, S&P was down 17.7% heading into today. That is the second worst start in the history of stock market, history of S&P 500, I should say. So it feels bad because it is bad. I'm not, you can't like paint over this. It is bad and it feels bad. So it's again, it's okay to feel this way. It sucks, but it's okay to feel this way. You know, and I talked about that 4,000 level in the S&P 500. I said, if we break there, which we did last week, and right now we're about 3,890 or so, give or take, on the S&P, that if we're anywhere between 3,400 and 3,600, around there, we start touching 3,600, which from here isn't that much more on downside. I mean, it'd be one more swoop down, but boy, I would be throwing money at the market, at stocks, maybe even just the S&P 500, maybe just the NASDAQ, and not looking at it for 5 to 10 years. Just let it go. And that's how you become a successful investor. That is how you look back and say, boy, how many times you say, boy, I wish I would have bought after the tech bubble. Boy, I wish I would have bought in 08, 09. Boy, I wish I would have bought on the COVID pullback. Yes. Well, you're getting another opportunity right now to do that. Do not ignore it. Do not ignore it, please. Retail. We got to talk about what happened yesterday with Target. TJT is a symbol of Target. We all know Target. Look at the sell-off on Target. Continuing today down to 5% right now. I'm going to zoom out a bit longer term chart. You can see how significant of a pullback this is. I mean, this is a massive, massive pullback on Target. And, you know, when I think about Target, I think to myself, you know, in times like this, and so let's go back to 2008. 2008, when the stock market was down, I think 38.5% for the calendar year, Walmart was actually up. It was a few stocks that was up. That is where people go in times of recession, in times of bear markets, in times of panic. You still have to buy your staples and go to Walmart and go to Target. So when Target came out with its number, they actually beat on revenue, meaning that's sales. How many, you know, they're actually sales. They actually beat the estimate. However, they missed the profit estimate by a big margin. And this is pretty simple to me to figure out why that happened. Because the company did come out and say that they could have as much as $1 billion in inflation-related costs. So what Target and Walmart are doing, in my opinion, is they're taking that short-term hit. So they're not passing along the higher cost of inflation, of buying their products and passing along to the consumers. The higher cost of fuel and diesel, getting things all around, the supply chain, getting the goods to the Walmarts from logistics centers, etc. They're not passing that along. Short term, it will take a hit like this, but I will say long term, I actually love this strategy. I'll tell you why. If you start raising costs at a Walmart or a Target, you're going to lose that customer that is extremely loyal. And maybe they go to a dollar store or somewhere else where maybe they're not passing along the cost. Because eventually we get past inflation. If you keep that customer coming, and you keep that loyalty from them because you didn't raise prices and try to, you're not really gouging them because you're passing along increases, but let's call it, you're not gouging them for every nickel and dime, you're not going to lose that customer. So when things get back to normal, when inflation comes back down, your customers are still there. I've run many businesses, I've owned many businesses. The hardest thing is to get a new customer. It's much easier, much cheaper actually to keep your customers. And again, you're going to take the hit in the near term, but I think if they stick with this strategy, I think it's a great strategy. And I think that's really the best way to go right here. I really do think it is the best way. And I think it will pay off in the end. So let's go to a chart here of retail sales real quick. And you can see here, this is U.S. retail sales going back to mid-2019. So about 3 years. Took a dip, obviously, during the pandemic. But still, we're at a high. So retail sales are still holding up. Could they kind of level off here? Sure, they could, but they're still holding up. And in that Target number, I was reading some of the report, they're saying that a lot of people are going away from discretionary things more towards staples, which makes perfect sense, but also we know what was selling really big? Luggage. Luggage was selling big. You know why? People want experiences versus goods. They want to experience things versus having things. And I've thought that trend was here for a long time, especially as the younger generation, millennials, Gen Xers, Gen Ys, whatever those other people are called. They are Gen Zs. They all like experiences. I personally am on the border of millennials and Gen Xer, a young Gen Xer. I love experiences. I'd rather travel for fun than sit home and have a nice car. Most of us feel that way, especially after realizing being stuck in a house for 2 years or so during the pandemic. We really miss travel. We miss experiences. So that's a real good sign to me that people are still getting out and doing things. But then the issue comes in is this chart, folks. This is the U.S. real average hourly earnings year over year change. Even though earnings are going up, what happens is they've fallen now for 13 consecutive months because of inflation. So our wages are going up. We're earning more, much more actually than we were a year or two ago. But the problem is when you put inflation into it, that's where that negative number comes to. Because you can see here, before inflation started taking off, year over year change was huge. 7%, that's a huge, huge increase. But as inflation started to hit, it came down. Again, when inflation goes away, it will go away or will subside. You'll see these come back up here. And you'll start seeing again, wage increases year over year, which means more people have money, which means retail sales go up. Don't forget, retail consumer makes up about 2/3 of our economy. So again, this will come back. And when it does come back, it will come back in a very strong way, in my opinion. So as much as the headlines are super ugly, there are some good things going on underneath. So you look at a Walmart, you look at a Target. I don't necessarily look to buy them right after these numbers because it usually takes a month or two to kind of get all the weak hands out, people to sell, get maybe a good number to come out. So I don't try to catch that falling knife down here. But I will say at some point, I'd say in the next 3 months, between now and maybe the next earnings report, we're going to have a great buying opportunity for Target, Walmart, and a couple others out there. Whether it be maybe like a Costco. Got crushed recently. Here's a chart of Costco coming off an all-time high above 600 down to 420. And again, I say this all the time, and it's like, when Costco's breaking out to 620, and I say, hey, listen, I'll sell it to you for 420. You'd say, I'll take it all day. Could it fall down to 320? Yes, it could. But again, you're in some sweet spot down here that eventually long-term, I believe it gets back to a new high and even a higher high. So it's tough, folks, to feel like there is an opportunity out there right now. And I get it. It is tough to feel that way. At the same time, it's tough to ignore kind of what we're seeing here right now. So let me give you an example. For example, Walmart, on the pullback that it's had, down to $119 a share right now, it now trades with a forward PE ratio about 16.7 and a forward price to sales ratio of 0.53, so very low. So you have a company continues to grow. You have a company that's now trading at a very nice valuation. And if you look at the price to sales ratio, it's at a lowest level that we have seen in a very long time. I'm looking at the chart here real quick. It's the lowest price to sales that we've seen going way back. Years. So it's now cheap compared to where it typically trades. Target, another one, for example, it's a $70 billion company. I just showed you a chart several times of how much it got hit. And, last year in 2021, they had sales of $93.5 billion. So you're trading at less than one sales of last year. This year, looking for 106. Growth's not huge. But again, if I look at the ratios, it's trading a forward PE ratio of 9.6, forward price of sales of 0.61, a PEG ratio, PE over growth of 0.17. All very, very low numbers. And, not just low, but low based on historical values. You haven't seen levels this low for Target in years. And again, I always want to preface this. It could get cheaper here. That pendulum, when it swings to oversold, can stay there for a while and go to extremes, become so irrational in near term. But again, longer term, I believe it does come back. And it comes back to fair value, then it goes back to overvalued again. And this could take years to get back on that side, but it doesn't stay in that extreme oversold forever. It will come back because eventually you have smart money, like you and I, big money, smart money that sees, I'm a long-term investor and I don't see America ending. I don't see the world ending. I don't think the global economy is going to blow up. So let's start buying into solid long-term companies. And that is what you're going to start seeing soon. So I really think you want to start preparing for that, folks. Again, I'm not saying you run out and buy right now, but maybe start building that watch list. Keep fine-tuning that watch list, looking for stocks that you've wanted to buy for years that are now coming down to prices that might be very attractive. And before I go on, I'll show you one more thing here. Here's the ARK Investment Fund, Innovation Fund. We're now at 4.23% in a high today. That's telling me something. Again, you know me. I don't care about one day or 1 week, but there's something that it's telling me. If this continues and it doesn't break the low of last week, this is saying we've flushed out. We've sold growth down to where it's going to be, and now we've sold off the consumer staples. Eventually, that money that I showed you, that huge cash value the large institutions are setting on, will come back into the market. And we want to be ready for that. And again, when we start seeing money come back in, it's probably going to happen fast. So you're not going to pick the bottom. You'll never pick the bottom. Let's look for that sweet spot. Let's try to find that. But this weekend, what I'm going to be doing is some deep research on the market, continue to fine-tune our watch list here. My team and I have been going through it the last couple of days. I met with them yesterday. A lot of us were in the office, which was very nice. And we're going to continue to do that. And I love times like this, and I hate times like this. I hate it because I don't ever want to see anybody who follows me losing money. I don't want to lose money. I want to see family and friends lose money in the market. That being said, I've lived through several of these. I've been in the market for over 20 years. When I see these opportunities, it also excites me because I know if we're buying in the next couple of weeks or months, that in a few years from now, we have a great opportunity to make a lot of money. And I know you all think I'm crazy by being bullish, but I get it every time. I got it in 08, 09, and I got it back in 2003. I got it in December of 2018. I got it in March of 2020 during COVID pullback. I get it. It's fine. I have thick skin. I could take it. But the track record shows for itself that buying in those times, they make you money. There's nothing you can say about that. It makes you money if you buy solid companies. So thank you so much, folks, for watching. I hope you have a wonderful, safe, happy weekend. It's going to be very hot up here. So stay cool. Find a pool, something. But more importantly, folks, smile. Be grateful. And realize that the market goes up and down. You'll have many, many bear markets and recessions in your lifetime. It's okay. The market's going to be here. We'll continue to hold your hand through this, and we're going to come out on the other side. So thank you so much for the support. Thank you so much for listening. Don't forget to share, like, subscribe, all that's good stuff. And we'll be back Tuesday. We'll talk to you then. Have a great, wonderful weekend. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.